Well, good morning. Thank you for joining me. We had the gross domestic product release come out about an hour ago. It's currently 6:40 a.m. here on the West Coast. And so I just want to delve into that and take a look at the market's response to this report, less this report. The market's response is really to yesterday's Fed news that came out, the Fed press conference. And anyway, we'll get into that. But first off, real quick, look at the GDP numbers. GDP declined by 0.9% in the second quarter of 2022. In the first quarter, GDP decreased by 1.6%. So we do have two consecutive quarters of negative GDP growth. The Biden administration scrambling for cover at this point. Not our fault. Uh, is saying technically we're not in a recession. It's two consecutive quarters. It does not define a recession. The recession has to be defined by the NEBR, National Economic Bureau of Research, I think is what it is, which is true. That part is true. What they're not telling you is, okay, the big problem we have right now in the country is interest rates have gone up. That's the way to combat inflation. And at least from the Fed's perspective, I would disagree, but anyway, I digress. They've jacked up interest rates, just a real shock to the system, if you will, to the economic system, and housing has just stopped. It has really slowed down quite a bit, and so the problem is you have all of these housing projects and construction projects going. They're not going to lay people off at this point. The question becomes what happens after those projects are over with, and that's when you're going to start to see the employment issues coming up, and that's going to be starting in November through next February, March. It's going to, on the track that we're on, it's not going to look pretty, and just mark my words, that's how it's going to go. And so they can make all these arguments they want for the here and now, but there's nothing looking forward that screams out that things are going to improve. The Fed is not going to improve things. They're raising interest rates. They're talking about, they haven't even run off their balance sheet yet. I mean, if you take a look at the asset numbers from the H401 reports, maybe I should put that into this video, because they have not even run off their balance sheet basically at all. I mean, a smidge. They've reduced it. It's laughable, and so it's a problem that we've got right now. There is nothing looking forward that screams out things are going to improve. Anyway, let's move on. Here we take a look at the chart coming from the Bureau of Economic Analysis. Decrease in real GDP reflects decreases in private inventory investment, residential fixed investment, federal government spending, state and local government spending, and non-residential fixed investment that were partly offset by increases in exports and personal consumption expenditures, imports, which are a subtraction from GDP. That's in table 2. All right. Let's just go slowly through the report, and we can see that this is an interesting little nugget. We've got current dollar GDP increasing 7.8%. That's good. The problem is the price index for gross domestic purchases increased by more, increased by 8.2%. Now, those aren't the only two things in the GDP report, but you can see the problems. Inflation is moving faster than increases in GDP, so it gives you a negative GDP report. Personal income, thankfully, that increased by 353 billion. That's a good number. Disposable income increased by 294 billion. Real disposable income decreased by 0.5%. So there again, there's the nub of the problem. Disposable personal income increasing by 6.6%, but when you factor in inflation, it decreased by 0.5%. So inflation is causing havoc with these GDP reports, which is completely and totally expected. Anyway, let's move on to a couple of things. Move on to go under the hood, if you will, of this report.